2017 calendar year, if you see, has been remarkably good for the equity markets across the globe as well as India. India more to do with many reforms which have been taken shape, especially GST, and nevertheless you have a lot of inflows coming into the domestic market. So this is, I think, one of the first years where you would have seen that even though the foreigners were a net negative in last 4 to 5 months, I think domestics have held up very well thanks to the inflows which have been coming to the extent of 20,000 odd crores per month, with a SIP book of now touching over 5,000 crores. So I think markets have really done well. Now it is more of a tough journey which is starting more from the earnings point of view. The market has rallied because of the flows, and now we have to really see the earnings kicking in, especially after GST and its effects on the slowdown in some of the sectors. So hopefully, maybe not this quarter. This quarter again the base is very low due to demonetization, and you will see good numbers. But I think the real base will start in Q4 onwards, and from there on we'll have to really see how the earnings momentum kick starts. So all in all, we are hopeful of good 2018 calendar year, but don't forget you have macro which is slightly weak as compared to maybe what it was 2-3 years back. You have oil at a higher levels. You have a problem of inflation kicking in and increasing. You have 10-year GSEC now. I think today it was around 7.29. So the interest rates cut is out of question, and maybe we might see a stable regime or maybe slight uptick if the inflation goes off the roof. Plus you are going into an election year, so next 1.5 years would be very challenging in terms of what kind of economic policies are taken shape, especially taking into account 2-3 state elections and the 2019 main election.
All right. Jinesh, we've been talking about how markets are pushing past their historic valuation peaks. Do you get that sense into 2018? Are you more optimistic? As the Economic Times front page headline says, we are bracing ourselves for another strong emerging market rally, India included, in the coming year.
So it's possible if earnings really catch up, because frankly the valuations are running high, and that is due to flows and more on the hope of many reforms which will help the earnings momentum, especially for the listed companies to kick in, which are more domestic driven sectors. If you see some of the sectors like auto, consumers have been doing really well, both in terms of stock performance, also holding on to some of the earnings growth number. So if that really continues, and if incrementally things improve, especially on the rural side, I think there could be a sort of a good 2018. However, please don't forget, valuations are ahead of expectations, so you really need to come out with better than estimated earnings estimates.
So what is your view then, Jinesh, on earnings? Do you think earnings would kick in a quarter or two, and would it be an overall across the board kind of growth, or do you think it's going to be much like the previous quarter, wherein you're going to see, only bouts and sprouts of economic activity as well as earnings pick up?
So I think the hope is that after 3.5 years of sort of a truncated earnings growth, truncated economic activity, I think momentum is really picking up at the ground level, especially 1 or 2 booster doses into the rural sector will help them grow faster than the urban centers. So it's early sign. We'll really have to see how the GST stabilizes, whether it takes 2 quarters, whether it takes 4 quarters, frankly difficult to guesstimate. But I think momentum is on the incremental. I think momentum is on the positive side, and things should look better if all goes well.
In terms of sectors, Jinesh, where would you be overweight and underweight respectively for 2018?
See, we have been consistently maintaining our stance on private sector banks, select NBFCs, auto ancillaries, and consumption theme. And Touchwood 2017 has played out as per our expectation. We'll see how things go by. Among the domestic theme, I think rural should be a theme should be looked at. However, we already have in some or the other way, direct or indirect, good rural place to play. So we would like to add there. We'll see how the technology sector shows performs in terms of business improvement, and if there is an uptake on the BFSI space in US, then obviously the technology space also looks slightly better.
A lot of people, Jinesh, are now beginning to bet on construction and EPC with view that, you know, the government's thrust on affordable housing, their focus on infrastructure. It's going to be the segment of companies which are likely to benefit. What is your own take on how EPC and construction should be looked at?
See, they are good place to play as a cyclical strategy, maybe 1 or 2 years in terms of getting returns. But from a structural perspective, since the entry barriers for this sector is so low that anyone can start a business and get orders. So if you take the history of last 10 years, you would have 10 new companies which have come up and 10 old companies which would have died down, except for few large companies which have been able to stay on course because of their diversification. So I think it doesn't help us to make a larger portion of our portfolio, but obviously as a tactical bet, if you get something good at a reasonable valuation, it is worth taking a bet.
Right. What's your view on, the PSU banking lot into the coming years? It's going to be a critical year for PSU banks, in the broad spectrum of, studying investment opportunities within the financial space, which is a key dominant holding in mutual fund portfolios. How do you view how financials would be invested in or approach into the new year?
Yeah, so I think recapitalization is a good move. It helps the banks get capital, which is the paramount raw material for them to grow or to make their balance sheet stronger. We'll have to see how the new resolution thing works out, how they are able to sell down all these assets which are an NPA in their books. And how they are able to grow their loan book. I think it's a bit murky as of now, given the thing that when we are talking to the bankers, barring 2 or 3 steel assets, there are no takers for others. And given the new IBC code, which is very stringent on promoters not participating into the stories, for buying out the asset, their own asset, I think we'll really have to see how much haircuts they will have to take down. Having said that, I think the good part is most of the pain has been taken into account. Now it is more of a resolution and recovery phase. Our view is it will take 1 or 2 years really for them to clean up their balance sheet. Don't forget there is an IFRS which is coming into play. We'll have to see how much provisions they will have to take on their net worth due to new law. So all this taken into account, it is bit murky. You will have to do case by case basis. You cannot take the entire bunch of PSU banks into account. And please don't forget the interest rates have bottomed out. 10-year GSEC is now at 7.29. So there could be some losses or maybe losses in profits in their GSEC portfolio. So the momentum of earnings will really have to come from loan book growth and hence the NII growth, which I think is still some time away before they really kickstart in terms of numbers.